Andrew Burkly joins us now to talk more about second quarter earnings season and the impact on the markets. He's portfolio strategist at Oppenheimer and Company. So, Andy, we got that positive news from Alcoa, and it came on the same day that Samsung warned investors of a possible 26% drop in its quarterly profits. So how is this earnings season shaping up in your view, and how's it going to play out in the markets?
Hey, Susie. Yeah, I think it's going to be a pretty good earnings season. I mean, we're looking for about 7% year-over-year growth for S&P 500 operating profits on about 3% revenue growth, which is, what we see the economic data currently tracking. So it looks like, after the soft patch in Q1, the economy is certainly reaccelerating here. And we think profit growth broadly, will be pretty good here in the second quarter. Probably most importantly for the markets is really going to be hearing what companies say in terms of forward guidance for the second half of the year, because we know that analysts' expectations for the second half are already pretty optimistic. So in order for them to push those numbers higher, which is what the market will really need to push significantly higher, we're going to need to see some better guidance coming from the companies as they report.
Andrew, which sectors might be the standouts or the laggards, and where might we spot some surprises?
I think, I'll start with energy as an interesting sector because we haven't seen energy sector post year-over-year growth since early in 2011. So it's been quite a period of time, and the sector seems to be hitting on all cylinders, broadly speaking. Certainly higher crude oil prices have helped, but in the equipment side, we've seen a lot of the infrastructure working as well. And then the refiners are been doing very well as also. So I think energy is an interesting one. I think really a key one is going to be financials because expectations for financials are relatively low. It's the only sector at this point that's expected to have negative year-over-year growth. And we think if when all is said and done, that might actually be a slight positive. So we think financials could be a key and really is a very important one for the overall market.
So, Andy, how vulnerable are the markets to a correction, especially if some high-profile bellwether stock reports an earnings miss or some negative number?
Yeah, I mean, whenever you're coming into an earnings season, you're close to an all-time high, and certainly as we've gotten over the Dow 17,000 milestone here, your likelihood of a correction or your vulnerability to correction certainly goes up, especially because valuations have crept up quite a bit on a PE multiple basis. We're at the high end of the range over the last 10 years or so. So I think there's a lot of good news priced into the market. It really is going to be up to earnings to come through. We think maybe somewhere in the 3 to 5% correction is probably more likely if we were to see some misses. We don't see a bigger correction than that, really, in terms until interest rates really start to move higher, and we think we're quite a bit away from that still.
So do you think the market, broadly speaking, the S&P and the Dow, can end the year higher, and if so, by roughly how much?
I think so. I mean, we've been looking for about a 10% year. We did 6% in the first half of the year, so that means we have less in the second half, probably about 4%. I think, you're going to see volatility pick up here as we go through the earnings season, but I think, you can get another 4 to 5% on top of this, which would be another double-digit year, which would be a good one.
All right. Good note to end the conversation on. Thanks a lot, Andy. Andrew Burkly with Oppenheimer and Company.